Good afternoon. It's good to be here. So let's talk about China. So they asked me, hey, John, would you like to come and speak a bit about what's happening to the economy, what's happening to the politics, what's going on with the geopolitical risks, the exports, the sanctions, the tariffs, and how the market is really volatile? So I say, sure. So a couple hours should do it, right? They say, no, you got 20 minutes. So in 20 minutes, let's cover some of these things that's on top of mind. First of all, the market is going haywire. It's crazy, right? Let's take a look. First of all, if you look at the next slide, you'll see that the market indeed, it popped and then it came back down. And really, as people talk about China today, the prevailing story is that Chinese economy is terrible. And it's not about to go anywhere unless the government stimulate. And the whole story is terrible economy, stimulus, and if you get the timing right, you buy the stock, you make money. But is it? Let's peel that off layer by layer and look at some of the underlying trends. It is true that the market popped because of the stimulus, and it's equally true that the stimulus has been disappointing so far and the market then drifted back down. But what is really going on in the economy? Are things really as bad as you are reading in the newspapers or seeing on TV? Well, let's start with a very complicated chart. The top third of the chart is indicators in the consumption sector. The middle part is industrial activities, and the bottom is imports. And the consumption activities will be things like cosmetic sales, jewelry sales, movie tickets, etc. The industrial activities will be things like industrial robots, the truck sales, rail volume, etc. Now, my point is not to ask you to read the chart one by one, but let's zoom out and look at the pictures. The green colors are good, the red is bad, and yellow is in between. And if you just look at this, you go, wait a second, the economy is actually quite mixed. Parts of it looks okay, and parts of it look really bad. So which part looks okay and which part look bad, and how is that going to evolve in the next couple years? Because ultimately, to make money in the stock market, you're not buying what's happening today. You're going to buy what is going to happen in the next 6 months, 12 months. Get ahead of that, position it before the fact, and that's how you make money, right? And everybody says, oh, we should buy low and sell high. Well, you know what? The market is pretty low today. But is this the right time to buy? How should you think about this? Back to this economy, if you look at what's happening is, on the consumption part of the economy, some are good, some are bad, but by and large, it's not terrible. The industrial part of the economy, on the other hand, is terrible. It's horrendous. And why is it so bad? The answer is, of course, the property sector. If you look at Chinese real estate, at the very peak, this is now 4 years ago, 2021, China was selling the equivalent of 1.6 billion square meter of housing. That's with a B, billion. Now, 2024, this is last year, China's sales volume fell from 1.6 billion to about 800 million. It's halved. Half of the housing sector is gone. And in our opinion, it's never going to come back ever again. And we're not done. If you do the bottom-up calculation, the real demand over the long term is probably 400 to 600 million square meter. So we're at 800 today. That's probably going to fall some more. But you know what? The magnitude of the fall is going to decrease. Over the last 4 years, we've lost 800 million square meter activities in China, right? That's a lot. It's gone. But in the next 4 years, are we going to lose another 800? No. We're going to lose 200, 300, right? The magnitude of impact is decreasing, and therefore, the drag on the economic growth was really bad in 2022, terrible in 23, mildly bad in 24, and then with each passing year, while it's negative, it's getting a little less bad. But what about the consumer? We just talked about that the consumers are holding up relatively okay. Now, let's look at the consumers' sentiment. Now, the numbers here is indicating how optimistic people are. The higher the number, which is green, is very optimistic, and the lower the number in the reds, which means people are not optimistic. And this chart is divided into, on the left-hand side, different tier cities. So first tier cities will be things like Beijing and Shanghai, all the way down to the smaller cities. And on the top, you can see this is divided by demographics, so different parts of the generation. Now, I think this is now very interesting because this was done right before the pivot in stimulus stance. So this was done in early September, before the government changed their policy, right? And if you look at which part of Chinese consumer is the most depressed, really is the millennial generation, particularly in bigger cities. Now, let's think about this for a second. If you're talking to someone from China, you go, oh, of course, you know, my family's from China, or I have an uncle in China, I have a cousin working in China, and they say things are terrible. That person that you know, talking about China, chances are is a 40-year-old living in Shanghai. And of course, they're super depressed. But what if you are a grandmother in your 60s living in Shanghai? You are happy as a clam today. These generation of people bought their house for nothing in the 1990s. They probably own 2 or 3 properties. They don't have any debt. And today they are drawing a pension. Things couldn't be better. Even if you are a younger person in the Gen Z and living in a smaller city, you know, instead of Beijing and Shanghai, maybe you are in Shunde, maybe you are in Jinan, things are actually pretty good too, right? And so my point is that I should talk about Chinese consumer is bad, Chinese economy is bad. The picture is much more nuanced. When it comes to consumers, parts of it is really bad, but there are also parts of it doing pretty well. Now, as a stock investor, if I were to buy a consumer clothing company, for example, and you know, we own some in our portfolio that are explicitly selling to the younger part of the population in smaller cities, their business is actually doing kind of okay today, right? And so if you look at China today, the picture is much, much more nuanced. We've just spent the last 5 minutes on what's going on in China right now. But what's going to happen to China in the long term? Let's zoom out a second and then make that comparison. I think most people, when they are today, if you read about economists talking about Chinese economy in the next 5-10 years, they are comparing China maybe to Japan. But to us, the proper comparison is probably to other Asian dragon economies. You know, this will be Korea and Taiwan. This will be things like Singapore or Hong Kong. And the Asian dragon experience, and I'm Taiwanese, right? So I remember this, but I think we have a lot of Singaporeans sitting in the audience. If you think about your own experience, the experience of the Asian dragon economy is in the 60s or 70s, you have a poor economy. You started to doing light manufacturing, maybe you make plastic flowers, t-shirts, sneakers, and to sell to the Americans, right? Walmart exports, and you start to make a bit of money. That money gets more investments into your country. You start to build infrastructure, roads get built, airports get built, railroads get built, and then the whole thing creates an economic boom. The banking sector gets built, and then you invariably ended up with a property bubble. It's true here, it's true in Taiwan, it's true in Korea. And that banking real estate bubble bursts. After that burst, you have a period of very low growth. It's pretty painful, it's an adjustment. But after that adjustment, you typically come out of that adjustment with a much lower absolute level of economic growth, like Taiwan, like Korea, right? Did you know that Taiwan and Korea in the 2000s is a 2% GDP growth economy? 2%. Doesn't grow much faster. But could you make money in Korea? Could you make money in Taiwan? I think we all agree you can, but the type of companies you invest and make money in those economies will look different after the transition than before the transition, right? Today, what's driving Korea, what's driving Taiwan is both their domestic consumption names, right? In Korea, it will be including things like K-pop or K-drama, Blackpink. Those are all actually consumer companies that are doing really well. And then they are value-added export companies, and we all know who they are, right? You all know the Samsung, the Hynix in Taiwan, you all know TSMC. Those companies are the ones that make money. So in China, to us, it's the same thing. What's happening is that on the left-hand side, I'm showing you Korea, but this might as well be China. The ROE, return on equity for the corporate sector, continues to decline because you're slowing. And yet on the right-hand side, again, I'm showing you the index for Korea. Throughout this process, you can make money. And the way you make money in those economies is actually no longer buying the growth stocks, but buying the value stocks, right? Because your go-go growth economic days are over. And so it really is a regime change. But you say, all right, John, let's say we believe you. Let's say I believe you, and then let's say we do agree that China is transitioning. But what about all these risks? Isn't America putting so much tariff on China? It's going to kill the economy. It doesn't really matter. Well, let's look at that for a second. So let's look at the export data for a second. In fact, let's change it around. Look at imports from an American point of view. The yellow line here is the percent of Chinese goods in the stuff Americans buy, market share of their imports. And if you look at the yellow line, it does look like that Chinese market share of American goods that they buy has been decreasing since Donald Trump began the trade war in 2018. But is that right? Because if you look at the blue line, which is the proxy of the same thing, but measured from the China point of view, actually Chinese exports are doing as well as they can be. But what's the gap? How can one be true and another also be true? The answer, of course, is that Chinese makers have spent the last 4 or 5 years, they figured it out. The way to circumvent American tariff is you put your factories in Vietnam, you put your factories in Mexico, and you continue to sell to US, right? And so we all heard that Apple computer, a lot of you use iPhones, I bet. A lot of you have iPads. We all heard that Apple has been shifting its iPhone production outside of China. In fact, it's now making iPads mostly outside of China. So Apple has really good data on their website. So I went to their website and I downloaded, and I list here for you all the Apple suppliers in Vietnam on the left-hand side, and all the Apple suppliers in India on the right-hand side of this page. Now, take a look at the names. Do you see any actual Vietnamese companies here? Do you see any actual big Indian companies here? It turns out that it's mostly the BYDs of the world. Instead of BYD Shenzhen, it's now BYD Hanoi Limited. That's making the goods. So my point is that tariff will hurt Chinese economy because factory jobs are moving to Vietnam. But remember, I'm an equity investor. We are buying stocks. And as far as stocks go, these are the same companies. No matter where if your factories are in China or your factories are in Vietnam, they all make money for us, the shareholders, at the end of the day. That's how I think we should think about the tariff risks in China. And that's how I think we can also make money regardless of what's happening. Now, if anybody is worried, by the way, then if you look at the chart, and it's very hard to squint, but the percent of the equity market revenue directly from the US in China is 2.6%. It's just very small. It's just very small at the end of the day. Now, let me sum up by a couple of things, right? So if you believe what I said about the economy, the longer-term trajectory of what's happening, then how do we think about the prospect of making money in China going forward? Well, first of all, let me look at the right-hand side of this page. It's a little complicated, but here I'm basically showing you the valuation or price-to-book ratio. And whenever the price-to-book ratio in the market at the end of December was 1.67 times in the China A market, there's a good chance, as you can see, in the next 24 months, that the return, if you hold the stock right now, based on history, is pretty decent. It's pretty good. Now, every cycle plays out differently, but remember, when the market is most depressed, whether it's 2008, everyone goes, oh my God, US equity, I'll never buy US stocks again. Or before that, 1997, oh my God, emerging market is blowing up, I'll never buy Asian stocks again. When people are most depressed, usually it's a pretty good opportunity, pretty good time to look at an asset class, because you never make a lot of money if you buy it really high, when the valuation is really high, but your chances are much better if you enter into a market when the valuation is a bit better. Just maybe one more minute about our portfolio, and we do have a booth in the back, right behind the stage over there, so do stop by and say hello and grab some of our information. But despite of what everyone said about Chinese market, maybe things are terrible, I don't know what's gonna happen. You know what? In the last year, you do act out a 16%, or at least our fund has a over 16% return measured in CNH or renminbi terms. But the point here I want to make is that in this market, things happen. A lot of policy changes, a lot of different developments in business models, new companies come, old companies go. And if you look at us, and this is how our bottom-up positions in terms of sector weights have been evolving over the last 15 years, and you can see this is a market that in order to make money, you have to be very close to it, you have to be very active, you have to very actively trade this market, because what makes money in January probably looks different than what makes money in June. It's a different market in the US. It's not like you can just buy a bunch of tech stocks and you go to sleep for 3 years and you wake up, things are fine. This is a market that things change a lot. And hopefully someone like us who are doing our homework on a bottom-up basis, staying close to the market, have a lot of resources and analysts in China, can help deliver that insights for our portfolio. Right, so with that, I want to thank you very much for your time. And do stop by our booth in the back. Thank you.